Bob, are we heading for a recession?
You'd be shocked. One of the challenges that we're facing right now is what I call a wrecking ball of policy mix. I hate to be the bearer of bad news here.
For people who are listening to this, if they are sitting on cash, should they continue to sit on it?
If you were buying bonds, this has been a great year for you. And a recession would be even better for you if you're holding bonds.
What should a person do if they have a lump sum of cash? Perhaps they got a big commission check, they got a big bonus, they sold their car, now they have a $20,000 check that's just burning a hole in their pocket.
They should do the same thing. The tariffs as implemented on Liberation Day, about 20% increase. That's a pretty significant shock to the system.
Bob Elliott is the former head of Ray Dalio's investment team at Bridgewater Associates, the world's largest hedge fund. He was an advisor to the White House, the Federal Reserve, and the Treasury during the 2008 financial crisis. Bob, welcome.
Thank you so much for having me.
Thank you for being here. Bob, are we heading for a recession?
I think there's a real high probability that that's going to happen.
Oh, geez.
Yeah.
That was not what I was hoping you would say.
Yeah. We've had, if anything, we've been very lucky the last few years that the U.S. economy has been persistently stronger than, most people had expected. And a big reason why that was because we had strong labor force growth, strong income growth, strong consumer spending, and asset prices that were rising. And one of the challenges that we're facing right now is what I call a wrecking ball of policy mix ahead, which is we have an administration that's come in, and you can argue about whether or not the sort of long-term goals make sense along their policy path, but it's pretty unambiguous that their policies that are being implemented are going to be growth negative in the short term, combined with the fact that we still have a persistent inflation problem, which means that the Fed is not going to be able to get ahead of any concerns about growth weakness. And that combined, a growth negative set of federal government policies and a Fed that is behind, is a pretty tough environment, particularly when we have asset prices that are just off all-time highs.
Right. So as of last month, the inflation rate was 2.8%. If these policies are growth negative, would that not in some ways help inflation by virtue of slowing growth, but in other ways harm by virtue of potentially driving up prices?
I think the question about whether the current tariff policies or the planned tariff policies are going to net be inflationary or disinflationary, I think there's a reasonable case on either side. If you're sitting in the Fed shoes, a lot of the academic literature and the empirical work suggests that they'll be inflationary. And so they'll be essentially be using that assessment as their default assumption about how this will flow through, and will need to see something meaningfully different in terms of the actual reported data before they change their stance. But while there's a lot of ambiguity about the inflationary, deflationary effect of tariffs, I think the thing that is not ambiguous is that they are growth negative. And the reason why that is pretty simple, which is that you're going to create an environment where a fair amount of goods that are coming into the economy, and we import a lot of goods. Go to Walmart, pretty much everything that's on the shelves of Walmart has been imported. And in a consumer economy, the prices of those things rising simply means that people will have less in their pockets to spend elsewhere. And so what that means is that the demand for real goods, whether it's for those goods that are being tariffed or for a broader set of services, that next vacation, that next trip, the haircut, et cetera, the demand for those are going to go down because more money is going to be drawn towards spending on tariffed goods that people need.
About 70% of the U.S. spending, it's consumer spending, it's discretionary consumer spending. Is that an over-concentration in that sector, and will this have the effect of causing more of our economy to be reflective of business spending?
The U.S. economy for a long time has been primarily driven by the consumer. And the reality is in most developed, diversified economies, it's really household consumption that is really driving the economy. And the reason why that is businesses in those sorts of economies, particularly in Western economies, are typically investing in response to the demand that they see rather than building for building's sake. It's different in places like China, where it's governmental policy to create high business investment with the hope that that will then create stronger consumer demand. In the U.S. and the rest of the West, it's essentially the opposite. Strong consumer demand leads to business investment. And so the household demand is really the linchpin of the U.S. economy. And so as household demand goes, so too goes the rest of the economy.
Now, you mentioned that tariffs are growth negative in the short term. And I know the philosophy behind them is that there's the hope that in the long term, it will onshore more manufacturing and create more jobs here. But the counter argument to that is that in an environment where tariffs might not be in place for a long enough time period, there might not simply be enough runway for all of the major capex to get spent for the re-onshoring of those jobs. How do you respond to all of that? Because you hear the argument, you hear the counter argument, both of those sound reasonable. Where do you fall?
Well, I think the reality is both could be true. If we were in a circumstance where, let's say, there's a 25% tariff on all manufactured goods that are coming to the United States, and that would persist for the next 10 years or 20 years, then businesses could start to think hard about whether it made sense to invest in things like automation or domestic production relative to the costs of importing goods and paying the tariff, either directly or indirectly. The challenge really is in an environment of a lot of uncertainty about how these policies are going to play out, businesses are basically frozen. I mean, think about it. If you were running a business, say a car company, and you were looking at this environment, and what you've experienced in the last 8 weeks is 25% tariffs, 0% tariffs, 25% tariffs, 0 and 25. What do you do with that? I mean, that is a extremely challenging environment. And it's one in which what you see is that business is always in an environment of high uncertainty. Just pull back. They just wait and see. It's also one of the reasons why, if you look at things like CEO confidence numbers for major U.S. corporations, they're the lowest that they've been since the financial crisis.
And is that because they don't know how to invest in an environment where things change?
How can you have any confidence when you don't know what the rules are? And I think that's the core challenge that businesses are facing. And while, of course, consumer demand is a primary driver of the economy, the fact that businesses are now basically curtailing any incremental spending on investment means that support to the economy has really evaporated. So it really is now down to basically whether households spend or not in an environment where they're effectively getting, in an indirect way, one of the biggest tax hikes that they've experienced in the last 100 years.
Right. How long would tariffs have to stay in place in order to create that re-onshoring of jobs?
Well, if you think about, let's just say in the auto space, like one of the things that's important to think about is we have created incredible efficiency in our manufacturing sector, right? The total amount of manufacturing sector output over the last 50 years has gone up by multiples, whereas the employment has been cut massively. And part of the reason why businesses have been able to do that onshore is they run very, very tight production that's intended to meet incremental demand. And so essentially, if you have a factory and it's not running essentially 3 shifts a day, fully employed, that's wasteful, and that's just not acceptable in today's environment. What that means is in order to build new productive capacity, let's say in cars, 50% of U.S. cars are met with domestic production and about 50% from offshore production. Well, you can't just snap your fingers and create double the production out of these factories because they are essentially already running about as tight as they possibly can. And so what you have to do is you have to build new factories. And building new factories is not something that you do at the snap of a finger. It's something that it could take 5 years to build a factory. And so it takes decades to actually get the payback from those. If you're sitting in the shoes of the CEO of Ford or GM and you're saying, should I build another factory or not? You've got to be thinking 30 years into the future. And so the economics have to look good on a 30-year time frame, not on a 6-week time frame.
Right. And given the fact that any given presidential administration happens in 4-year increments, how would it even be possible for tariffs to be in place long enough for the CEO of a major company to make that type of choice?
It's possible. For instance, we saw some of the 2018 tariffs that were placed on China were persisted into the Biden administration, now obviously have increased substantially in the second Trump administration. So, it's possible that there could be continuity around tariff policy between different administrations. But I hear you, it's very ambiguous. I think that's why, in a lot of ways, if you're building productive capacity domestically today, you're doing it in one of two different ways. Either it's so compelling in terms of automation and efficiency that under a wide variety of circumstances, you're going to be competitive. Or what you're doing is you're basically just building domestic capacity to meet domestic demand in that particular good. That way you don't have to deal with, there could be tariffs, there could not be tariffs, but my factory is in the US, I'm producing for a US audience, and therefore what happens with international trade policy isn't going to matter that much. And that's why what you see is companies like BMW or Toyota, et cetera, building domestic, U.S. domestic production capacity in part in order to insulate themselves from these sort of cross-border conflicts. But still, the U.S. imports hundreds of billions of dollars of automobiles as a simple example. So it's not like all of the U.S. demand for cars is being met by U.S. production.
Right. And that does make sense. Domestic production to meet domestic demand, overseas production to meet overseas demand. I'm thinking about during the pandemic in 2020 when the price of lumber suddenly spiked, and it was because there were these supply chain disruptions, and yet the cost of making more lumber, the cost of creating the factories necessary to increase lumber production, the time scale of that was too long to be able to meet this very dynamic kind of upset in supply and demand. But yet that issue very quickly ended up working itself out through the normal mechanisms of supply and demand. So there was a lumber spike and it lasted for a few months and then it calmed itself down and everybody forgot about it and we all lived happily ever after. Is that type of thing likely to happen now? You know, at this current moment with the tariffs being new, there's a lot of upheaval. Will it, like lumber in 2020, work itself out over the next few months through normal free market mechanisms?
Well, I think probably what we're going to see is we're going to see over an extended period of time the development of a significant amount of parallelization of supply chains. So we went from a world that was global, integrated, and just in time to a world that's going to be fragmented and parallel and with a lot of redundancy in supply chains. And as I said, that started in COVID because obviously the COVID disruptions created a lot of supply chain issues. But these tariff policies, I think, in many ways are going to exacerbate that need to create redundancy in the supply chain and in manufacturing. And almost by definition, the world was moving towards the lowest cost production, the most efficient production for 50 years, something like that. And as we transition to a world where we have a lot of redundancy, and that redundancy is in higher cost production areas almost by definition, right? If the economy was set up so that the reason why China produced, for instance, washing machines and laundry baskets and stuff like that was because they were the lowest cost, most efficient producer. Well, if you start to produce those things in the United States, almost by definition, the United States is not the lowest cost, most efficient producer. And so that's what creates price pressure, right? There's inflationary pressure in duplicating the supply chains, and then there's inflationary pressure in producing out of higher cost areas. And that's really, when you think about sort of the strategic effects, the longer term effects, just going back kind of to your question a little bit before, was you can get benefit from employment, from incremental employment from the tariffs onshoring production, but that onshored production is happening at a higher cost. And as a result, essentially what you're doing is you're socializing that cost to everyone who's spending on that good in the economy. And so that's the trade-off. In many ways you could think about, and the fact that you're going to have higher costs in general globally means that demand is going to go down because higher costs mean that people are just going to spend less, are going to be able to buy fewer units. And so you have the combination of tariffs bringing down the overall demand infrastructure, the overall demand in the economy, and then you have this significant redistribution from essentially consumers who pay for it and the companies that meet those consumers through their margins to the workforce that is producing those goods. And how that nets out, it's hard to fully know, is the reality, how that all nets out. No economy has ever implemented instantaneous 20% tariffs, certainly any economies that are as large as and complex as the United States. So we'll see. But in general, the story is much more around the consumer loss meaningfully overwhelms any benefit to a small sector of the economy that gets improved employment as a result.
Right. Now, you've talked about how functionally the general public, or at least the people who purchase an item that has been subject to tariffs, functionally have a higher tax that they're paying because that cost has now gone up. And when I think about the overall economy, it strikes me that there are four levers, right? There's the lever of tariffs, there's the lever of tax policy, there's the lever that comes from the Fed when it comes to monetary policy, and there's the lever of government spending. Mm-hmm. And so what I'm wondering is, oftentimes when we talk about any one of these factors, it's common to have that conversation in isolation. And so, like right now, we're having a discussion about tariffs specifically, but how can we have a framework to think about the way in which all four of these levers work in concert with each other?
Yeah, it's a good question. You want to think about first each one of those pieces individually and how they will have their own discrete effects, and then think about how they intersect with each other to then create maybe compounded effects in one direction or another. So if we just go to your framework here, and I think this connects well with the wrecking ball environment that I was discussing at the top, which is we have tariffs, which are likely sort of unambiguously a negative growth policy. You have fiscal spending, while the magnitudes are a bit ambiguous, is clearly moving in one direction, which is that spending is getting cut. Mm-hmm. Combination of DOGE efforts, let's call it internal administration efforts, combined with Congress, who is taking steps to cut back on spending, particularly to a variety of different programs for lower income folks like SNAP and Medicaid. That's a pretty negative environment. You mentioned tax policy, mm-hmm. right? Tax policy, there's a lot of talk about sort of a big tax cut,
right?
Particularly when it comes to the extension of what's called the TCJA,
mm-hmm.
which
the Tax Cuts and Jobs Act,
right? The Tax Cuts and Jobs Act, which sort of more commonly is known as the Trump tax cuts back mm-hmm. when he was in his first administration. One of the things that's important to recognize there is that those tax cuts are already current law. Mm-hmm. So if they get extended, they'll have no effect. Essentially, by extending the tax cuts, all you're doing is ensuring that there wouldn't be a tax hike occurring, mm-hmm. but you actually are not getting any meaningful tax relief, mm-hmm. which is important. So there's a zero effect of the tax cut extension. Mm-hmm. And then finally, let's put it on the board as tariffs, meaningful drag, spending cuts somewhere between a modest to moderate drag, tax cuts, zero. And then you have a Fed, which is slow moving in an environment of elevated inflation where they're going to be behind the curve. Let's just say that. So it's going to take a lot of pain before they start to really move to ease. That combination of things is pretty bad in terms of I hate to be the bearer of bad news here, but if you don't think about it as what you prefer to have happen in terms of the economy, just think about the macroeconomic mechanics and what the effects are of each one of those different pieces. And when you look at each one of those different pieces, with the sort of eye that a doctor would look at a patient's blood work or something like that, you see basically that that's netting out to something that's pretty negative in the short term.
Right.
Real downer, I know.
You mentioned that maintaining the Tax Cuts and Jobs Act would have a neutral effect. Mm-hmm. My assumption is if it goes through, that the alternative would be further drag. So if the tax cuts were to expire, then we would functionally have a tax hike.
That's exactly right. And I think pretty much everyone in Washington is on board with not letting the Trump tax cuts roll off. It would be a pretty significant tax hike across the board, and one that would be certainly undesirable in the context of all these other things that are going on. And in some ways, if you look at the commentary from more fiscally conservative elements, particularly of the Republican Party, they see that there's a package here, which is that we'll extend the tax cuts out, but in order to make sure that that doesn't continue to have the sort of elevated deficits that we've had for a while now, we need to essentially get what's called pay-fors. So something's got to pay for those tax cuts to get extended. And so the revenue raised from the tariffs, which the most recent policy, that could be $400 or $500 billion a year. That's actually pretty significant. It's about a quarter of the deficit, just in terms of orders of magnitude, combined with the spending cuts, which the budget process proposed something like $200 or $300 billion a year in budgetary cuts. That kind of is enough to pay for most of the cost, essentially the implicit cost of continuing the tax cuts that exist, so that we have something that's starting to bring the budget into balance, which is, it's not the top goal of the new administration and the Republican Party, but it is certainly an important goal that they're pursuing through their work.
Right. Now, what about, we saw in the February jobs report that even though jobs at the federal level had a slight reduction, we saw that government jobs at the state and local level actually had a gain. That's the most recent data that's out. We're recording this on the first Thursday of April. And so tomorrow morning, which is the first Friday at 8:30 a.m. Eastern, we're going to get the March jobs report, but we don't have it yet, so we're going to use February's data. As of February's data, government jobs, when you include state and local, actually had a slight net gain. How does that factor into this?
Well, when you think about the labor market, government jobs are about 10-ish% of the aggregate labor market. And federal government jobs are only a few percent of the overall workers, about 2.5 million folks who work for the federal government, excluding postal services and the military, which are not necessarily discretionary efforts. They're kind of independent of the sort of normal discretionary budget. So 2.5 million, it's actually been flat basically for 50 or 60 years, which is kind of incredible when you think about how much the economy has grown. One of the things that's kind of interesting is the new administration is going through a process of thinking about whether there's efficiency that can be gained from cutting back on those jobs. And there's been some documentation that's being circulated internally around cutting about a third of those jobs. So that would be 800,000 workers, give or take. 800,000 workers in today's labor market is actually about 6 months of labor force growth. That's a pretty big set of cuts were they to happen over a 6 or 12-month period. They could essentially erase all the other job gains that would happen in the economy because we're an aging workforce. Demographics are such that the number of prime-aged workers is starting to fade meaningfully, and we don't have nearly as much immigration as we had the last couple of years. And so that would be a big shock to the system, putting in laying off 800,000 folks. You're right that some of those are being picked up by state and local governments, although state and local government employment, it has risen in recent years. It's mostly recovering from the COVID-related drop, and is now recovering from that. And so the level of, for instance, state and local employees today relative to where we were pre-COVID, it's only up a few 100,000 jobs. And so the big picture story is the vast majority of the labor market dynamics and gains have been consolidated in the private sector. The vast, vast majority, about 90%, has been in the private sector. And nonetheless, these sorts of cuts that are being discussed could be meaningful drag on the labor market in the next 6 to 12 months.
Should we all flee into global bonds? Is that, because it sounds as though I'm hearing about a lot of negative drag that bodes poorly for the U.S., certainly equities market, but kind of also the bond market. Like it's another 2022 in which it seems like they might be moving in tandem rather than inversely.
Yeah. The challenge with 2022 is we had a lot of inflation volatility and a lot of inflation uncertainty. What I describe here is the range of plausible outcomes on inflation. While tariffs are meaningful and will affect overall demand, the range of likely outcomes related to inflation is much narrower today than it was back in 2022. And so most of the volatility or the uncertainty that you see in the market today is really about how growth is going to play out. And that's why I emphasize the tariffs, they could be inflationary, they could be deflationary, hard to know. But what they certainly are is negative for growth. And environments that are negative for growth are good environments to be holding bonds. And in particular, good environments to be holding bonds relative to stocks. And so that's what we've seen in the market action so far. We've seen in the last couple of weeks, we've seen bond yields come down, meaning bond prices have gone up, have rallied, at a time when stock prices have come down. And that's really reflective of the fact that the market is starting to price in a more negative growth environment. But let's remember, if you just look at something like where stocks are today, stocks are only down 7% year to date as of today. It's not that big a deal. If you've been in this business long enough, 7%, things go up, things go down. That's not a huge repricing. Certainly nothing it can to the type of 25 or 30% declines you typically see in a recessionary environment. And bond yields have come down tens of basis points, but this is certainly nothing like the sort of moves that we saw during more acute economic downturns. You look at that, and it's true, there's been some increased pricing of weaker economic conditions ahead, but we're really at the tip of the iceberg. If you believe that the tariffs will exist for an extended period of time and that there will be spending cuts and that the Fed will be slow to move, there's a lot more pricing that can be unwound in terms of bonds rallying relative to stocks.
And that relates to U.S. bonds, but what about global bonds? Like, it seems as though, at least the impression that I get is that the ECB is going to be more likely to make some interest rate cuts. They seem to be moving faster than the U.S. Fed.
Yeah, I mean, Europe is in a circumstance where they're an inflation targeting central bank. And so they're primarily focused on inflation. But what I'd emphasize with the ECB is that they've gone through probably a roughly 30-year transition to soft money. And when I mean soft money, if you go back 15, 20 years right after the financial crisis, there was a short spike in inflation that happened that brought inflation in Europe from a little under 2 to a little over 2. And in response, the central bank at the time tightened aggressively. Now, that kicked off the European debt crisis, which was then met with massive stimulation and liquidity to ensure that it would not persist or get worse. That marked an important transition point. The ECB, which was originally modeled off of the Bundesbank, which was intended to be highly sensitive to inflationary pressures, basically gave up that criteria about 15 years ago to save the euro as a currency. The result is that even though today European inflation as measured is still above their benchmark, and the projections are that inflation will be above their benchmark for the next few years, the ECB is cutting because they've moved to a soft money set of policies.
What about the Bank of England?
It's a little more challenging in the Bank of England's case because inflation has been a little more persistent there. Labor markets have been tighter and wage growth has been a little more elevated. And as a function of that, they've been slow moving in terms of delivering meaningful accommodation in terms of their policy. They look a lot closer to the Fed on the margin with a bit of a bias to a bit easier policy, but not in a position to move as aggressively to ease as some of the other central banks.
Right. Are they still projecting that they'll hit the 2% target in 2026?
They also are projecting that they will not meet their targets for an extended period of time. I mean, look, every central bank, every major developed central bank is saying that they're not going to meet their inflation targets for a long time. The interesting thing is that each one is approaching that circumstance differently. Europe is basically saying, forget it, just keep easing, right? It's fine, don't stress about it. Japan is saying we're comfortable running very easy monetary policy because we've had deflation for the 30 years before, so maybe we shouldn't stomp out this expansion, what modest expansion is occurring. Whereas places like the UK and the US are a little more cautious in terms of delivering a big easing cycle given the fact that there's this inflation persistence that they're experiencing.
Going back to the model of the four levers, one thing that strikes me is that we have two major disruptions that are happening right now. One is the tariffs, of course, as we've been talking about, and the other is the reduction in government spending. Can you talk about the fact that both of these are happening simultaneously? What combined effect do these have? I mean, if either one of these was happening without the other, it would still be disruptive. So how do the two together play off each other?
I think one of the ways to think about, let's call it the compounded effect of the intersection of these policies, is to think about how they work through the lens of asset markets. Because in some ways you can think about asset markets as they're sort of the lever that determines how households respond to the conditions that they see and how much they choose to save versus spend. And so if you have something, combination of the tariff policy with the cuts to spending, that creates a negative growth shock. So that negative growth shock is in the context of equity markets in particular that are still pricing in pretty strong growth ahead. For a few years in 2023 and 24, equity markets were pricing in very weak economic conditions. And everyone probably remembers 100% probability of recession, which did not come in 2023, right?
Right.
And so while there's a lot of talk about individual stock names and things like that, like from a macro guy's perspective, basically what it looks like is that what happened was everyone expected a recession didn't come and stocks went up. And the same basic thing happened in 2023. Everyone expected slow growth, or 2024. Everyone expected slow growth. Growth wasn't slow. Stocks went up. Well, the challenge that you have in this environment really entering 2025, and that's still in place, is equity markets kind of gave up on the slow growth vibe. And we're like, no, actually growth is going to be super strong just at a time when you had the fiscal policies that were coming into place that were going to be a growth negative. And so you put those two things together, and that is a negative growth shock against high expectations. And that's just in the same way stocks outperformed because the economy was stronger than people expected. You could easily see a circumstance where stocks are weak because the economy is much weaker than people expected. And that decline in stocks then flows through to household demand and creates a self-reinforcing dynamic, because part of the reason why household demand has been so strong is because, look, if you see your 401k and your stock account goes up every day, what are you going to do? You're going to spend more than you would otherwise, right? You wouldn't pull back. And what we're starting to see with the initial data earlier this year is that there's some signs that households are pulling back on their demand. So they're spending less of their income because they're seeing, instead of equities going up 20% a year, they're starting to flatten out and fall. And so now households are starting to think hard about, do they want to keep spending as rapidly as they were, or do they want to, sock some away for the future? The problem is when you sock some away for the future, that creates less demand, that creates less income, and that creates a weaker growth environment that's self-reinforcing back to stocks. And so you have, in many ways, the spark of the fiscal negative growth policies, the fiscal tightening that we described, that's kind of the spark. The kindling is very high expectations. And then the fire is households cutting back and creating the self-reinforcing dynamic that further weakens the economy.
Now, I've heard the hypothesis that it is not asset prices, but rather income and wage growth that would drive household spending. And so, according to this hypothesis, there's a significant portion of the U.S. population that is not invested in the stock market at all. And there's another portion of the population that only has very minor investments in the stock market, represented by maybe a small 401k balance or a small 403b balance. But that, according to this particular hypothesis, the degree to which asset values are a concern for ordinary households is overblown. And as long as ordinary households have, number one, employment, which employment is historically very strong, and number two, sufficient income and wage growth, that alone will keep household confidence high and keep spending high. What do you think of that?
That sort of positions it as an either or rather than thinking about it as a set of linkages that move through time. And so I think you're totally right. For 2/3 of households in the U.S. economy, the thing that matters is whether they have a job or not. Absolutely right. Maybe on the margin, interest rates kind of matter because if they're financing an auto or something like that, or maybe their mortgage, interest rates matter to some extent. But really, it's about whether you have a job. The issue, those folks are primarily spending out of their income, meaning they get their paycheck and they spend out of their paycheck. Maybe they save a little bit on the side, but what drives the volatility of their behavior is whether they're employed. As a function of the volatility of their spending is predominantly driven by the volatility of the employment conditions. The volatility of employment conditions is driven by the volatility of overall spending. And so if you instead have 2/3 of the economy that has much more volatile spending, that is driven by asset prices, or at least meaningfully influenced by asset prices, not by no means exclusive, that is the part of the economy that shifts demand that then creates the knock-on consequences to the rest of the economy. So even though it's totally right, the vast majority of the economy is employment and income sensitive, they're not the predominant areas of the economy that are leading and volatile. And so when you want to understand how the economy is going to work, you want to focus on those sectors that are leading and volatile, and that then has the second and third order effects through the economy.
That makes sense. You mentioned that there's a high likelihood of a recession. Now, when I think of recessions, there's really two factors at play. There's severity and there's duration. Do you have any predictions for either or both of the severity or the duration of what we might be expecting?
The first thing I say is there's still a lot of uncertainty because there's so much policy uncertainty. So we could have an environment where a lot of the fiscal tightening gets unwound. In order to understand what's likely to happen, you have to have a good, essentially mark-to-market sense of what that policy mix looks like. But let's just take the current policy mix for granted. Just say this is what's going to happen. The tariffs as implemented on Liberation Day, about 20% increase in essentially the effective tariff rate in the United States. Let's take the budgetary cuts that were in the past budget as given, a few $100 billion on top of the tariffs. That's a pretty significant shock to the system that would create relatively acute decline in economic conditions, which we may already be seeing to some extent. We see it in the soft data, not quite yet in the hard data, and would probably create a more meaningful consequence on the stock market. So something like 25%, if it was believed that those policies would persist. That's the sort of thing that would create, in a lot of ways, creates like a normal recession. Now, most people who are in the markets today actually have never seen a normal recession, right? You've seen COVID, which is not really even a recession at all, kind of
that was like a 1 month.
An exogenous shock, exactly. And you've seen the financial crisis, which really wasn't a traditional recession because so much of the pain and challenge was concentrated in financial intermediaries and the banks, and whether the banks were going to go broke and all the second and third order consequences related to that. It wasn't really like a traditional recession where you get expectations are high, growth slows relative to those expectations, asset prices fall, you get a bit of a self-reinforcing dynamic, asset prices fall further. You haven't really seen that. And so in that more typical recessionary environment, what happens is you get economic and market weakness, and then eventually what happens is you get fiscal easing and you get monetary easing. That's the way it works. And when the fiscal easing and the monetary easing comes in, that starts to change the economics of incremental behavior, and it starts to lift the economy again. Typically, it takes 20 or 30% down in stocks for that to happen, and typically it takes a couple quarters of weak economic conditions to get the Fed and the federal government moving it along to start to provide some stimulation. My guess is we'd see something akin to that in this circumstance because there's not like a problem in the financial system. It's not like the financial crisis where the banks were broke. We're not really seeing that. A lot of that stuff has been sort of cleaned up and dealt with over the last 15 years. And so my guess is we would see about a year and a half of weakness, some moderate declines in asset prices as a function of that weakness and reflexive of that weakness. And then you'd get enough, when I say easing, it could just be rolling back the tariffs, it could be rolling back the cuts, it could be providing other stimulus efforts, and that would, and then you'd have the Fed easing, and that would be enough to sort of bring the economy back. I don't know, the end of 2026, something like that.
We talked about the four levers, right? And how those four levers all work in concert with each other. The piece that I have not asked about, the Arctic ice circle is melting. We've got these new shipping routes opening up. And so we now have what they're calling the cold rush. How is that going to change the fifth lever that we've now just started talking about?
Yeah, when you think about long-term growth, what determines long-term growth is population growth and productivity growth. And in a lot of ways, these new sort of frontiers, whether it's in AI or in geographic frontiers, they have the opportunity to create longer-term productivity, essentially. In a lot of ways, there's no thing that creates wealth other than long-term productivity. The only thing that creates long-term wealth from a societal perspective. And so in a lot of ways, these things are super promising along that dimension, right? If we can harness the power of new geographic areas and explore them, and whether it's the raw materials and the resources there or other opportunities that we probably haven't even imagined, that creates a lot of opportunity for the economy. I think when someone is investing, and if you think about it, if you buy stocks and you hold them for 50 years, essentially the only thing that matters is earnings over a 50-year time frame. And the main thing that drives earnings over a 50-year time frame is growth. And the main thing that drives growth over a 50-year time frame is productivity. So from a long-term saver's perspective, these things are fantastic. AI, going to Mars, like all these different things are have incredible promise to advance wealth in the civilization. That's why you want to be a long-term investor in companies that are a part of that. The challenge is the thing that drives the stock market on the day-to-day basis is how people are perceiving the next 6 to 12 months. And so all the volatility is in the next 6 to 12 months, right? Is being driven by the next 6 to 12 months. And the reality is, part of the reason why there's so much volatility is no one really knows what's going to happen in the next 6 to 12 months. If you ask me what's going to happen in the next 50 years, I'd say things are going to be good, right? Things are looking up, right? And in part because things are always looking up over a 50-year time frame. But the challenge is being able to see through the volatility of people's perceptions in the next 6 to 12 months to stick to your game plan to take advantage of the long-term growth potential that will happen over 25 or 50 years.
You mentioned AI. There are a lot of people who are very bullish about AI. There's also a lot of concern about encroaching competition from China. It strikes me that positivity over the next 50 years cannot be taken for granted, because in an environment where there's argument that 50 years from now other countries might be more powerful than the US, perhaps we may or may not be the world's reserve currency anymore. There are climate change ramifications that we don't know how severe the consequences are going to be. We have some ideas, but that's certainly a major area of concern for many people. So thinking probabilistically, do we know that 50 years from now will be good? Even if the hypothesis is that it is, how do we mitigate the risk that we're wrong?
It's interesting because, a fair amount of this conversation, you could say, was very bearish in terms of what's, and at the same time, I'm an ultra bull from a long-term perspective, because I think when you look at the ability to generate advancements in the US and the global economy over hundreds of years, we're pretty good at it. And particularly having learned a fair amount of lessons about how to be better at it has accelerated our ability. Look, for 1,000 years, growth was essentially zero. And then in part because we didn't have institutional structures that were effective at unleashing people's creative power. And so in that sense, you don't know who's going to be the winner. So maybe China's the winner, maybe somewhere else that we haven't even thought about is maybe Africa's the winner. Right, 50 years from now. They have the highest population growth of anyone.
Right, they have the youngest population.
The youngest population, the highest population growth. Maybe it's India. All of these different places. It's hard to know. Part of the reason why you want to be diversified is because you don't know. You don't necessarily want to only bet on USA to be the only success into the future. But if we're talking about the global economy 50 or 75 years from now, it is unambiguous that we will be meaningfully better off 50 or 75 years from now than we are today. So part of the story is getting diversified and sticking to the game plan in order to take advantage of that, and not being too sidetracked on tactical ups and downs along the way.
So for people who are listening to this, if they are sitting on cash, should they continue to sit on it? I'm not asking you to make investment recommendations, but for the average listener who's wondering, all right, here's a lot of information about what is happening in this current market, but as an individual, what do I do?
Yep. For most individuals, it's actually funny. I was having a drink with an old friend of mine who works at one of the blue chip hedge funds here in New York. You'd think this guy was pretty sophisticated when it came to personal finance, but he's not particularly sophisticated. And he's like, look, Bob, I've just been dollar cost averaging into assets for the last couple of years. Do you think that that's a good idea to keep doing? And the answer is yes. The answer is yes. So when you think about investing, assets almost always will outperform cash. So holding large amounts of cash doesn't make sense because you will always have a cash drag as a function of it. Similarly, trying to tactically trade, I'll tell you, as a professional, it's hard enough as a professional to actively trade. If it's not your full-time job and you haven't spent decades doing it, it's even harder to generate good returns trading tactically over time. And so basically every person, whether you're a senior person working at a hedge fund, or you're a person just socking away a little bit of money out of your paycheck every day, is much better off just every month putting a little bit of money into stocks, a little bit of money into bonds, maybe a little bit of money into things like gold or some alternative assets like that to create a nice diversified portfolio. Just do that every month and don't think about it. And if you're able to do that, a nice diversified portfolio and you put a little away every month. Just think about this period. What that allows you to do, if you're dollar cost averaging, it allows you to buy lower prices. Prices go down, you buy lower prices. And if prices go up, then you get the appreciation from your previous purchases. And if you're buying things like both stocks and bonds, you're getting enough diversification. A lot of people focus on the stock market every day, but bonds have had a heck of a year. If you were buying bonds, this was a great year. This has been a great year for you. And a recession would be even better for you if you're holding bonds. That's why it's so important that people don't overly concentrate in one asset or another, because it's very hard to know exactly how the economy is going to play out. So those two core principles, dollar cost average and diversify, and you're going to be okay. And I should probably say, I'm not really a personal finance person. Finding ways to reduce or eliminate your taxes in the savings that you are doing is also, essentially, that's pure alpha, right? If you can reduce your tax burden, that is just simply a benefit to you over your long-term savings.
Dollar cost averaging makes a lot of sense when it comes to how to handle a periodic paycheck, because by definition, you can't invest money that you haven't earned yet.
Right.
What should a person do if they have a lump sum of cash? Perhaps they got a big commission check, they got a big bonus, they got a big windfall in some manner. They sold their car because they don't need one anymore. Now they have a $20,000 check that's just burning a hole in their pocket.
They should do the same thing. Dollar cost average. The thing you don't want to do is you don't want to time. Either you don't want to time out of trying to have skill, and you don't want to time out of trying to have luck, because you could time it well or you could time it poorly. And I imagine most of the people who are listening to this are thinking about, how do you build wealth over the long term strategically, right? And that is not, in a lot of ways, dollar cost averaging is time-based diversification, right? So in the same way you want to have asset-based diversification, you want to have time-based diversification. And so by doing that, by dollar cost averaging, you basically don't put yourself in a position to not be particularly at risk that today is a good day or a bad day to buy a particular asset.
Right. But by virtue of dollar cost averaging, if you have a large lump sum of money, aren't you overweighted in cash for the duration of the dollar cost averaging period?
Yes. And so the question is, like, how fast do you want to move on the dollar cost averaging versus the cash drag that you experience? And everyone's going to have different preferences, and it depends on if you got a lump sum every 12 months, then effectively you could just dollar cost average every month, over time, et cetera. I think when you have a sum of money burning a hole in your pocket, you always feel like you got to do something with it. And part of managing money or investing, it's a psychological game. There's the math and the macroeconomics and all that. It's also a psychological game. And so part of the benefit of doing something like averaging into positions over time is you take away the emotions of the day. You just say, every month, and the first of the month, I'm just putting $100 into stocks and $100 into bonds, and that's just what you do. And you just keep doing that and you'll be okay. More important than having the perfect possible strategy is having a strategy you can stick with. And so that's one of the things that I find very valuable about that is it becomes, if that's just your norm, you just do that every, all the time, it becomes your norm of how you operate, and you get comfortable with just, frankly, things go up, things go down, and you don't even think about it, which I know is hard, but there's a reason why passive folks generally beat active investing. There's a reason why the old stories of the person who lost their username and password to their investment account actually does better than the average person. It's because you're better off just sticking to the game plan and investing incrementally over time than you are doing anything else. And take that from a person who spent decades in active management.
So tell me about that then. You've spent your decades in active management. Did you have this philosophy during that time, or is this a philosophy that has more recently formed?
I'd say from a long-term strategic savings perspective, I've strongly believed in this philosophy. I have found working with a financial advisor can be very beneficial because what it does is it creates a hurdle for you to do something.
Right.
So as a simple example, since I was investing some small amounts of money from caddying, I basically had the philosophy that I've worked out with my financial advisor, which is I trade once a year. I trade once a year. That's it. That's all I get. I get one day a year. Usually it's the Wednesday before Thanksgiving because not much is going on. and that's it. That's all I get. So whatever I'm going to do, I'm allowed to do it one time, and that's all I get to do. That's an incredibly effective way of holding yourself accountable to not overtrade, not try and time markets, et cetera, in your strategic saving. And part of that is a function of, and I think actually this is the case for a lot of people, the last thing you want to be doing when you're working is thinking about your strategic savings portfolio, right? That is the sort of thing that can really drag you down, or your personal finances. So running your personal finances in a way that allows you to go do wealth building activities, whether it's your job or your side hustle or whatever it is, give yourself the space with your strategic savings portfolio to be able to not have to be too concerned about the day-to-day of that strategic savings portfolio, so you can focus yourself on wealth building.
That absolutely makes sense. The other side of wealth building is giving, and I wanted to ask you about that. So tell me about your involvement with GiveWell. Can you tell us what GiveWell is for those who don't have immediate name recognition for it?
GiveWell is I'd call it a modern charity evaluator. So there's been a lot of efforts over the last couple decades to better sort of identify which charities are, to be blunt, good and which ones are bad, right? The vast majority of charitable activities and nonprofit activities have pure intent and are trying to deliver important services all throughout the U.S. economy and globally, but there's some bad apples, and so figuring out which ones have red flags, let's say, is important. There's a whole industry that cropped up basically focused on that, looking at their annual reports and basically identifying programs that were concerning. Well, programs that are concerning, that's cutting out the risky areas where you might give. But what it didn't answer was a very simple question, which we had when we started GiveWell, which was, where can I have the most impact for my dollars?
Right.
It started a couple colleagues together at Bridgewater where we said, it's the end of the year, and we want to do some annual giving. And so we just simply, it sounds so obvious now, but we just simply said, okay, so what's the most effective thing to give to? And we divvied up. Someone took U.S. education, and someone took U.S. primary care, and someone took foreign public health issues. I'd spent time working on public health issues in college and stuff like that. So that's an area I was particularly interested in, and basically asked the question, like, go look at all the different things that are out there.
So when I hear the methodology, it sounds a lot like effective altruism. Is that the metric that you use? Number of lives saved per dollar?
Yeah. While the organization wasn't sort of explicitly designed around effective altruism, mostly because we were just some people sitting around a table trying to figure out what to do, a lot of essentially the goals are aligned with the same sort of goals, which is, how do you make the most impact? And I think there's a lot of different ways to look at that. You could think about lives saved. You could think about the amount of quality life saved, the quality of life saved or improved. There's a lot of different metrics that you can use. That sort of core concept of focusing on outcomes as a key metric in determining success, and focusing on provable programs, not theoretical programs, but provable, extensible programs that have a track record, preferably independently triangulated, published material showing a track record that intervention, let's say, is effective over time.
Now, what strikes me about that is that, and correct me if I'm wrong, but there are other charity ranking websites that will use metrics such as the proportion of your dollar that goes towards administrative overhead as compared to the proportion of your dollar that goes towards direct programs. And so I've seen other charity ranking sites that look at the budgetary breakdown as a method of ranking. And what I hear from you is a completely different methodology where, in theory, you don't really care what the budgetary breakdown is so long as the outcomes are present. How did you arrive on that?
Well, I think it comes from a real business focus, which is around not getting too worried about all the different line items, because then if you start to focus on the line items, you can play with the line items, you can change the line items. I mean, as a simple example, some of those ranking websites will penalize for the amount of program expense that exists, rather than essentially what's described as like direct capital going to the people who are being served. Like, there are program expenses. Like, if you've got to get malaria bed nets to people in rural areas in Southern Africa, there's lots of programming expenses. There's definitely administrative expenses, overhead expenses. All of those things are necessary to deliver the thing that is needed. If you only said the cost of the net versus all the ways it took to get the net into the person's hands so that they were sleeping in it in the night, it would be a silly way to think about the effectiveness of the program. And so we were laser focused on outcomes, and you'd be shocked. You'd be shocked. When we started this, we were very surprised at how little most interventions have been studied. Are they effective or are they not effective? There's a lot of programming that's out there where there's no independent or third-party triangulation to say, what are the outcomes related to this relative to the costs associated with them? I think back to, we studied at the outset one particular question, which is basically how do you get better rates of high school graduation or lower rates of incarceration in a community. And there's tons of programming, when at the time we studied, tons of programming, well-intentioned. These are not people who are trying to scam anyone. These are very well-intentioned people targeting high school students and targeting job skills at the high school level. Very well-intentioned programs have basically little to no discernible effect in terms of life outcomes. But we saw one of the things that had one of the greatest effects was if a nurse visited a family multiple times in the first year after the child was born to help answer questions about child rearing, help ensure that they were sufficiently vaccinated, all these different sort of core fundamental health effects. How interesting. That was thousands of times more effective at benefiting communities' long-term outcome, which could be measured by income or incarceration or high school graduation, college graduation, all these different metrics. Way more effective to just do that than engage with students in the high school level. And so this isn't an indictment of people who try and deliver those programs to the high school level. But if what you're focused on is how do you deliver the best outcomes for people, which I think 98% of the people who are in the NGO community, that's what they really care about, then using data-driven insights into understanding what actually works is so important. And you'll find that things that seem so simple, honestly, have huge levered effects that are very cost-effective.
Now, if a person wanted to donate, so myself as an ordinary individual, if I wanted to, I prefer to donate to charities that are relatively small because I like the idea that my donation will be a noticeable proportion of their overall operating budget. Is there a method for very small organizations to be evaluated?
Yeah, there's probably more information than you'd ever want to read about these programs on the website. And what I'd say is there's a wide range of different sizes of organizations that are involved in it. The key question is really about, do they have the capacity to deliver the program? Meaning, what you don't want to have happen, and again, lots of very well-intentioned people, but often what you'll see is a lot of capital flow to certain NGOs that may not have actual capacity to deliver a program. You don't want that, right? You want your money to affect and improve the lives of people around you. Part of the idea here is find those organizations that have the capacity, almost down to literal programs that would either not happen if they didn't get the money or happen if they do get the money, whether it's countries, county sites, city sites, particular things where there are clearly delineated programs that will occur because someone has contributed to those programs in a very targeted way. That's really, and one of the neat things about this, again, if you donate, you look at the normal charity evaluator sites, you don't really know exactly where's the money going, do they have programs? It's pretty opaque. We actually started GiveWell, we called it the Clear Fund, because the idea was total transparency about everything that was going on. And there might be more transparency than most people want, but the idea is also create a culture where those organizations that are receiving the money also have transparency to the donors about where it's getting used, why it's getting used, how effective it is, et cetera. And so I think that creates a good cultural environment where people can feel connected and see the actual effects of their work.
Now, with regard to the scale of GiveWell, I mean, you said $1 billion. What was it?
Yeah, it's between $500 million and $1 billion in the last year or so was directly and indirectly channeled through GiveWell recommendations.
Wow. So how is it that like a handful of guys sitting around a card table 15 years ago. How does that lead to $1 billion channeled through, right? Well, take me through that life cycle.
A lot of hard work. I mean,
Yeah.
I was very much fortunate to be at the start of it and to chair the board while it transitioned from the 8 of us around a table to being, a standalone organization. But what it has taken is a significant amount of folks who believe in the mission of building a better charity evaluator, donating to GiveWell specifically, so that there are there's teams of researchers in the same way there are teams of researchers at the world's biggest hedge funds. There are teams of researchers around topics, exploring those topics in a rigorous way. That's what's necessary to do it. And so the partners who believe in that mission, and part of the benefit of that is by believing in that mission and creating that content that's publicly available, it means that for the everyday person, folks like yourself, when you donate, you can contribute to the research effort, but you don't have to, which is great, because it means, back to your question, how do you know that your money's being used? That's one of the ways that you can have essentially 100% impact with the capital that you're giving to these chosen organizations. So it's really about it's a team that has grown to bring the same sort of rigorousness that you would have with investment strategy and just bringing it to the world of nonprofit efforts and evaluation.
You mentioned researchers, and it strikes me that GiveWell is very rooted in researchers, right? That's necessary for the work that GiveWell does. But your background, of course, is Bridgewater hedge fund, which is also very research driven. So tell me about the theme that I'm seeing throughout your projects is a heavy research focus. Tell me about how you manage good research, right? Because there's certainly a distinction between good research and mediocre. How do you manage and how do you evaluate good research? And how else do you carry that through other projects?
Yeah, in a lot of ways, I see myself trying to bring sort of systemization and quantitative thinking to what often is seen as non-quantitative questions. I mean, as you mentioned, I started my career in macro investing, and back 20, 25 years ago, the idea that you could use quantification and systemization to do macro investing was kind of a crazy idea. The sort of old macro traders were like old guys who kind of like looked at the newspaper and were like, the pound is going down today, and putting on huge bets, right? These were sort of savants of trading. There's all the savants that were unsuccessful we've never heard of. We've only heard of the successful savants. And the idea then around systemization was this idea of if you can create edge, which the idea is if you can systematically or quantitatively understand how the macroeconomy is going to play out, and then you can create a systematic understanding of that, and then you can leverage that systematic understanding and bet it over and over and over again, you're creating a small repeatable edge with large sample size, generates good returns over time. That is the key to most alpha, so to speak, is that most alpha generation are not savants reading the newspaper. They are people who work tirelessly to have modest edge and just do it over and over and over again. And the reality is, when you look out across a lot of different areas, there's not a lot of folks in public finance and in hedge funds. That idea was uncommon 25 years ago, and now is mostly ubiquitous. There's a lot of other places in the world where that isn't ubiquitous. So charity evaluation, it's not ubiquitous. After I left Bridgewater, I built a pharmaceutical commercialization business where that was not a ubiquitous thing, thinking systematically about how you connect with doctors who have patients that could benefit from a therapy. I also ran a venture fund, $125 million venture fund, which did systematic venture investing. I mean, talk about something where the idea of systemization and quantification is totally foreign to the way of thinking. Most venture investors, what they do is they sit across the table from the entrepreneur and they look them in the eye and they say, is this the type of person who will succeed? There's obviously, what are the sales and the margins and all that stuff, but ultimately a big part of what determines whether or not someone is going to get invested in is does the entrepreneur have the it factor? And the answer is that's totally random, right? And you could do a lot better if you just look at whether or not the product, quantitatively, if the product is competing effectively against the other products it's competing against in the market to see whether it's going to be successful over time. And so you sort of look at all that, and that's really a lot of what I've been focused on. And obviously I have a passion and interest in the macroeconomy because I started my career there and did that for many years and still find it fascinating and interesting and write about it regularly. But a lot of what I've done in the last 5 or 10 years has been figuring out where are the areas where you can bring this concept of systemization and quantification to generate insight into, whether it's investing or charitable giving in a way that other people can't see.
And so what are you working on right now?
Yeah, so when I'm not tweeting about what's going on in the global economy, my day job is actually in many ways challenging the hedge fund industry that I started my career in. So a couple of years ago, I sort of had been in the what I call the 2 and 20 industry, whether it's both the venture capital industry and hedge funds for a long time, and sort of realized a lot of these 2 and 20 strategies, managers, it's a good business for the manager and it's not a great business for the investor. And the reason why that is because most managers, they generate lots of alpha, but they take it away in fees. And that stinks for the investor, right? And it means that in reality, most investors, say as the person who has made a career in the 2 and 20 business, you should not invest in 2 and 20 strategies because they are a bad deal for the everyday investor. And so that got me to start to think about whether there was a way to bring concepts of diversified low-cost indexing, which obviously has totally changed stock investing and bond investing in the last couple of decades, whether we could do it in 2 and 20. And that's pretty neat because a lot of investors, the biggest, most sophisticated institutions in the world, they invest in 2 and 20 strategies, hedge funds and such. And the way that they do it is very interesting, is they end up going to all the big funds. Let's say you're a big sovereign wealth fund. You got $500 billion of assets. You go to all the major hedge funds and you say, I want to invest in you. I'm going to invest in 50 of you. And because I got a lot of money, I'm not paying 2 and 20. I'm paying a lot less than 2 and 20. And so what do you see these funds do? They basically create diversified low-cost indexes for their strategies, right? Through the force of their wealth. Well, so the idea that got me thinking about, well, could we do that for the everyday investor so that they could get access to those strategies in a diversified alpha is what I call it, diversified hedge fund strategies. So we couldn't invest directly in the funds because you got to pay the managers 2 and 20 and then yourself, and then that's too many fees. So that's a terrible way to do it. And that's kind of the problem with all sort of access to alternative strategies, is that almost every access to alternatives strategy is adding to the fee problem, not taking away from the fee problem. And so our idea instead was to basically take our experience having built hedge fund strategies for years and build technology that actually allows us to look over the shoulder of how those hedge fund managers are positioned in real time. And with that understanding, we can then take that sort of understanding of long and short positions, say global macro managers, are they long bonds or short bonds, long stocks or short stocks, the currencies or commodities, et cetera, and package that into a wrapper, an ETF wrapper that makes it available for all investors at a low cost in a way that's tax efficient. And so that's really, that's what I've been working on a lot in the last couple of years, is this idea of diversified low-cost indexing for 2 and 20 strategies, right? Driven by proprietary technology that infers how all these folks are positioned and then just makes it available to everyone. We've got a ETF in the market, which sort of proven that the technology works the last couple of years, HFND ETF, which you can think about as like the SPY for hedge funds. So in the same way you might buy SPY or another index, like a bond index fund like TLT, this is kind of the same thing for the hedge fund industry. And what's really exciting is we're now coming out with new products over the course of the next couple of quarters, which are individual hedge fund strategies, whether it's global macro strategies, managed future strategies, some strategies that have the opportunity to generate alpha in bumpy market environments.
When those come out, how can people find out about that?
The nice thing about launching ETFs is that they're almost always available across all the major discount platforms. So things like Schwab and TD and Robinhood, et cetera. So if you're
Vanguard, Fidelity.
a lot of those, Vanguard, Fidelity. If you're self-directed brokerage, you can find those startup ETFs and invest in them directly. And I mean, I guess if people want to learn more about what we're up to, you can definitely check out unlimitedfunds.com, which has a lot more information about the products themselves.
Nice. Well, thank you for spending this time with us today.
Yeah, thanks so much for having me.